Hi everyone, this is Vishal Bera from Reliance Academy. Today we'll be discussing about a topic which is extremely ongoing right now in the market. There are many people in the market who are assuming that the rally in the market is over and the current ongoing rally is pretty much not broad based. Only few stocks are participating in this entire rally, and probably this is the right time to get out of the market to book profits in the stocks where you're making money. The another type of trader is saying that the matter of fact the price is going up is enough to let you stay in this rally and probably not get out of the market. Well, my way of seeing things is slightly different. I don't want to take any personal views in the market as of now. At times, market does come at a juncture where it is extremely difficult to analyze and even take a personal view and a decision that what should be the next step as a trader, as an investor, what you should be really doing as of now. Now, today I'll show you a small, simple technique which is called the trailing stop loss. This particular technique helps you to stay in the rally, and till the time the market is going on, you're still making money. And as soon as the market starts falling, automatically you will get out of the market and probably you'll book some profits. Yes, maybe you have not caught the exact top in the market, which actually no one can, but the meaty part, the main part, the big rally, you'll always participate and make money out of it. So probably today I will show you just one simple indicator. Now this indicator is a 40 days exponential moving average of the close of the price. Now first let me be very clear, my friends, this is a very simple indicator. This is not a very advanced indicator which actually advanced technical analysts use. So today I'll just be sharing with this simple indicator. Now how one should use it? One should be using it in such a way that whenever, suppose if you're holding something long, let's take a stock like say Yes Bank, which has recently fallen. Now this stock, this recently did came down. Okay, now as a trader you should first understand that whenever stock closes below this particular moving average, it does tell you that it is the time to exit that particular stock. Now if you see very clearly, I'll just mark those points. There are two different points where consistently the moving average did signal you that, friends, this is the time to exit the market. What was that price? That price was somewhere around 350 and somewhere over here at 357. So from 357 the stock came down to 298, right? So what I mean to say over here is, suppose if you're long in a stock, say from the levels of 295 or whatever, and the stock has been going up beautifully, at this particular point you should be trying and exiting that particular stock. Why? Because your trailing stop losses have been hit. With the profit going up, with your profitability in your account going up, your protection, your stop loss should also rise. There should be some sort of protection for your profits, right, my friends? What do people understand in trading is that only your entry is more important. No, it is absolutely wrong. More than your entry, exit is more important, because there are many traders, many investors who just know where to take an entry, but none of them know where to take the exit. Because ultimately, if you initiate a trade which is going to end in a loss, suppose it's a trade which you initiate and immediately it starts going down, at that point of time your exit is going to save you from your losses being exceeding. Okay, and if you are in a trade which is extremely profitable, your exit is going to help you to not let the profits reduce. Why? Because same thing happened in Yes Bank few months back, or probably in 2017 itself. The rally started somewhere at 242 over here and it went all the way till 330, and somewhere at 296 you got an exit, and from 296, if you see properly, the stock came down till 275. So you should have exited somewhere over here, and then later on you get a second entry. So this is how a trader should be using this particular tool, and not take any personalized views in the market. Now, the stock Reliance Capital, if you see properly, Reliance has given two major rallies in the year of 2017. There are two major swings. The first rally started somewhere at 411 or 415. From that point onwards, it went all the way till 635. But your exit came at 569. But when you exited at 569, you should understand that you had gone long somewhere at 420 or 415 or 411, and you have made enough amount of money. And if you don't exit at 570, your stock drops till 480. Okay. Now my question to all those people who say that what if I was holding this particular stock and not exiting? Well, I would just like to say one thing is, what if that stock would have never rallied from this point? What if this stock would have gone till 360? Would you be still in a profit? The answer is a big fat no. So rather than taking personalized views, rather than using a lot of thought process, what should be one doing is just keeping trailing stop losses. And this is a big amount of money, my friends. From 411 to 570 is a big amount of money just within the matter of 5 months or 4.5 months. The second rally in Reliance Capital we can see in at 553, which started in mid-June and it ended somewhere in mid-September or ending of September. So somewhere from 553 the stock rallied till 661. This is also a very decent amount of money. Someone should have exited somewhere over here, right? Because from 661 the stock did correct till 530. Why you should be holding such a stock which has stopped going up? That is what we need to understand. Now a stock like Maruti, if you see in this particular stock, what has happened is the rally started somewhere over here when the stock started closing above this moving average, right? At 52.31. From 52.31 there were few times where the stock tried to close below this moving average, but it was not successful in doing so, and the stock kept on rallying. The first close you got below this moving average was at 7457. So even if you have exited somewhere over here at 7457, and if you have entered somewhere over here at 5200, do you think that this is a very small amount of money in just a matter of say 8 to 9 months? The answer is big fat no. So what I'm trying to say over here is that whenever market is at a juncture where the rally is thinning out, only few stocks are taking the index on the upside, rather than taking personalized views, rather than asking each and every one that is this the right time to exit? Has the market topped out? Are the valuations extremely overstretched? Well, let those calculations be done by someone else. Let's not make things complicated, and let the things be very simple. Just keep a trailing stop loss. If your stock is going to rally further 20% up or 10% up or even 25% up, you will remain in that particular rally because your trailing stop loss has not been yet hit. If it is hit and if the stock comes down, but obviously you will be exiting and you will come out. So the worry, the fear that if the stock comes down by 40% from the top, I will lose all my profitability, that particular fear will not be there anymore if you know how to use trailing stop losses. Just before ending this video, I just want to say one thing, that this indicator is not ideal indicator to use as a trailing stop loss. This is just a simple ideology, a simple strategy which you can use in your trading and try to be in the market till the time the market is going up. There are several other indicators which are on the advanced level and will aid you as a trailing stop loss in a much better way. So that's all, my friends, for right now. Trade well, trade wisely.